Viking Holdings beat Q2 consensus. Revenue hit $2.19 billion, which is a 16.5% year-over-year increase, and EPS came in at $1.31, beating the $1.25 estimate.
Right. And their forward-looking guidance is just as robust. Like 2026 core capacity is already 96% sold out, and 2027 is 53% booked.
So naturally, the stock initially popped 2.7% pre-market on those numbers, but then we saw this vicious sell-the-news intraday reversal. It dropped nearly 9% down to $89.50.
Yeah, that is a massive swing for a single day.
It really is. So today we are doing a deep dive to figure out why a massive beat and incredibly strong forward guidance would trigger a 9% sell-off by lunch.
Well, to understand that disconnect, you really have to look past the headline numbers. We have to dig into where their operational strength is actually coming from right now.
Okay, so looking at the segments.
Yeah, adjusted EBITDA jumped 18.2% to $748.4 million. But what you really want to look at is how they are squeezing more value out of every single passenger.
I mean, their core segments are demonstrating serious pricing power. River net yields rose 8.8% to $660.
Which is huge.
Right. And ocean net yields increased 7.7% to $593. So that tells me they aren't just filling ships. They are commanding a premium because affluent demand is just wildly outstripping supply.
Exactly. But that brings us to the crucial context management provided around those forward numbers. CFO Lynn Bond specifically warned analysts on the call about getting, a little too excited over the 2027 advanced bookings.
Because those advanced bookings are currently up 21%.
Right, they are. But she cautioned against extrapolating that current double-digit yield premium into long-term financial models.
Yeah, think about it like buying tickets to a concert. The most expensive VIP seats always sell out first.
Always.
That 2027 yield premium is artificially inflated right now because wealthy travelers are booking premium long-haul itineraries way in advance, places like Egypt and Vietnam.
Exactly, the high-margin stuff. Management knows that as their standard core European inventory gradually sells out closer to the sale dates, that massive yield growth is going to normalize back down to the mid-single digits.
And that normalization is vital for tempering long-term expectations. But, it is fundamentally a longer-term trend.
Right. A slow normalization in 2027 doesn't explain a sudden 9% haircut today.
Exactly. So what is hitting them right now to cause that kind of immediate panic?
The immediate catalyst is severe environmental risk. We are seeing historically low water levels on the Rhine and Danube rivers. And it is turning into a massive logistical and financial headache for them.
Yeah. CEO Leah Talaktak confirmed on the call that this is impacting over 50% of their Q3 river capacity days. That is an enormous disruption for their core product.
Oh, absolutely. It's forcing 10 to 12% cruise cancellations outright.
Wow, 12%.
Yeah, and for the ships that are running, Viking is eating massive incremental transport costs. They literally have to charter buses to move guests around unnavigable stretches of the river.
Which totally eats into those great margins we just talked about.
Exactly. And this is why, as a retail investor, you need to care about this. It perfectly illustrates how bulletproof trailing financials can be entirely overshadowed by forward-looking operational vulnerabilities.
Record revenue and beating EPS don't matter if you physically can't sail your ships.
Right. You can have the best margins in the industry, but if weather disruptions prevent your core product from operating, the market is going to reprice that risk instantly.
So consider this final thread to untangle on your own. Because of these current cancellations, Viking is issuing future cruise vouchers to affected guests rather than taking a direct cash refund hit today.
Yeah, and management is spinning this on the call as a savvy strategy to build long-term brand loyalty.
But look at the underlying mechanics of that strategy. Consider how this essentially creates a mountain of phantom debt that is going to quietly cannibalize those highly touted margins when the vouchers are finally redeemed in 2027 and 2028.
It's true. Viking is going to be sailing fully booked ships where a noticeable percentage of the passengers are non-revenue generating.
It's a delayed financial hit hiding right there in plain sight on the balance sheet. Well, that wraps up today's deep dive into Viking's quarter. Make sure to follow the show for your daily earnings coverage, and we will catch you next time.